Discover a step-by-step approach to assembling a portfolio designed for steady monthly dividend income and long-term compounding. If you've ever dreamed of collecting a paycheck from your investments every month, this video is for you. Building a monthly dividend paycheck portfolio isn't just about chasing high yields. It's about creating sustainable, reliable income that can grow over time. Whether you want to supplement your current income, plan for retirement, or just get started with investing, understanding how to build an income-focused portfolio is an essential skill. In this video, I'll walk you through how to set up your own monthly dividend portfolio from scratch. We'll cover the basics, look at some practical examples, and explain key terms you'll need to know without any confusing jargon. Remember, this is not financial advice. Always do your own research and consider speaking with a qualified professional before making investment decisions. So, why does building a monthly dividend portfolio matter? For many investors, regular income is the goal. Unlike growth stocks, which may not pay dividends at all, dividend stocks pay you cash, usually every quarter and sometimes every month, just for holding them. But there's more to it than just getting paid. Reinvesting those dividends can create a powerful compounding effect. Over time, your portfolio can grow faster and your income can increase as well. Plus, a well-built dividend portfolio can provide a sense of stability, especially during market ups and downs. Let's dive into the step-by-step process. Step 1. Understand the basics of dividend investing. When you buy shares of a dividend-paying company, you're entitled to a share of its profits, paid out as dividends. Most U.S. companies pay dividends quarterly, every 3 months. Some companies, especially certain real estate investment trusts, business development companies, and Canadian stocks, pay dividends monthly. Key terms to know. Dividend yield. This is the percentage of your investment you'll receive in dividends each year. For example, if a stock pays $1 per year in dividends and costs $20 per share, the dividend yield is 5%. Payout ratio. This tells you what percentage of a company's earnings are paid out as dividends. A lower payout ratio can signal that the dividend is safer and more sustainable. Diversification. This means spreading your investments across different companies, sectors, and even countries to reduce risk. Step 2. Decide how much you want to invest and set your income goal. Let's say you want to generate $200 a month in dividend income, or $2,400 per year. To estimate how much you'll need to invest, divide your annual income goal by your expected average dividend yield. For example, if you're targeting a 4% average yield, you'd need about $60,000 invested. $2,400 divided by 0.04. If you're starting small, that's okay. The key is to be consistent and keep adding to your investments over time. Step 3. Choose your investments with monthly dividends in mind. To build a true monthly paycheck, you have 2 main options. Option 1, invest in stocks and funds that pay dividends every month. Some well-known monthly payers include Realty Income, ticker symbol O, Stag Industrial, ticker STAG, and Main Street Capital, ticker MAIN. There are also monthly dividend exchange-traded funds, or ETFs, like the Global X Super Dividend ETF, ticker as DIV, and the iShares Preferred and Income Securities ETF, ticker PFF. Option 2. Combine quarterly dividend payers to fill in the gaps. Most stocks pay quarterly, but that their payment schedules are staggered. For example, Coca-Cola, Johnson & Johnson, and Procter & Gamble all pay quarterly, but in different months. By holding a mix of these stocks, you can smooth out your income so you receive dividends every month. Here's a simple example. Let's say you own shares in Realty Income, O, which pays monthly, Johnson & Johnson, JNJ, which pays in March, June, September, and December, PepsiCo, PEP, which pays in January, March, June, and September, Tant, T, which pays in February, May, August, and November. With this mix, you'd receive at least some dividend income every month of the year. Step 4. Check for sustainability and safety. A high dividend yield might look attractive, but it can also signal risk. Double-check the payout ratio. If a company is paying out almost all its profits as dividends, it may not have enough cushion if profits fall. For example, a payout ratio under 70% is generally considered safe for most companies. Real estate investment trusts and some funds may have higher ratios, but that's normal for their business models. Also, look at the company's dividend history. Has it been paying and ideally increasing its dividend for years? Companies known as dividend aristocrats have raised their payments for at least 25 consecutive years. Examples include Procter & Gamble, Johnson & Johnson, and Coca-Cola. Step 5. Diversify for stability. Don't put all your eggs in one basket. Spread your investments across different sectors, like real estate, consumer goods, utilities, and telecommunications. This way, if one industry hits a rough patch, your income won't dry up. Consider international diversification as well. Some Canadian and European companies pay monthly or staggered dividends, which can help fill in your calendar. If you prefer a hands-off approach, monthly dividend ETFs or mutual funds can provide built-in diversification. For example, the Schwab US Dividend Equity ETF, ticker SCHD, pays dividends quarterly, but because it holds many companies with different payment schedules, you may receive payments in most months. Step 6. Reinvest and monitor. If you don't need the income right away, consider reinvesting your dividends. Many brokerages offer dividend reinvestment plans, or DRIPs, which automatically use your dividends to buy more shares, compounding your returns. Keep an eye on your portfolio at least once or twice a year. Make sure your companies are still healthy, the dividends are sustainable, and your diversification is intact. Let's recap the key steps. Start with an income goal and estimate how much you'll need to invest based on your target yield. Or choose a mix of monthly and quarterly dividend payers to create a steady stream of income. Focus on companies and funds with a track record of reliable, sustainable dividends. Diversify across sectors and, if possible, countries. Reinvest your dividends for compounding if you don't need the income immediately. Review your portfolio regularly to stay on track. Before we wrap up, let's quickly revisit the key terms. Dividend yield is the annual dividend divided by the stock price, your expected income as a percentage. Payout ratio shows how much of the company's profit goes to dividends. Lower is generally safer. Diversification means owning different types of investments to reduce risk and smooth out your income. Building a monthly dividend paycheck portfolio takes some planning, but it's absolutely doable for beginners and intermediate investors. Start with what you can, even if it's just a small amount. Over time, consistency and compounding can make a big difference. If you found this guide helpful, please like this video, subscribe for more clear, calm investing insights, and let me know in the comments, what's your dividend income goal? Or which monthly dividend stock or ETF are you most interested in? Thanks for watching, and remember, investing is a journey, not a race. See you in the next video.